Hey everyone. So today's episode was one of my favorites. We got to have on Solana legend, also known as Diego. He's the co-founder and managing partner at Frictionless Capital. And we had him on to talk about the future of internet capital markets, which is a term he helped popularize. We also talked about the legality and importance of sharing revenues via tokens. We touched on what's missing from current launch platforms like Believe. And then to wrap up, we talked about how DePIN creates new markets and how investors can still find big opportunities in public markets, even if you're not a VC. If you love the idea of internet capital markets, this episode is for you. Hello, everyone. Welcome back to the Dashcoin Research Podcast. I'm your host, Nicholas Wenzel, and today I have Diego with me. Diego works at Frictionless. They're focused on high throughput blockchains and all the products that those high throughput blockchains enable. They've been doing really well recently. Diego, it's awesome to have you here.
Thanks for having me back, Nicholas. It's great to be here.
I always see you talking about internet capital markets. You were one of the first people who really honed in on that phrase back in January, maybe even before then. But you definitely have a lot of tweets. I encourage people to go check your profile and search your profile for internet capital markets and read all the stuff you've written about it. And that's why I wanted to have you here, because I think you have a lot of unique takes on it. So let's first start with what internet capital markets means to you. What's different to the normal capital market?
Yeah, so maybe taking a step back, it's helpful for the audience to get a bit of a refresh on what capital markets are. I think capital markets at their core, people think of equity capital markets or debt capital markets or whatever that is. But in the aggregate, capital markets, their function in the world is to take essentially willing risk capital that essentially is excess capital that people don't need immediately for running a business or for expenditures. And they want to park it in various investments, whether that's debt profile or equity or some sort of hybrid for basically in the pursuit of interest income or capital gains, some sort of growth or income opportunity or tax optimization. So essentially, at its core, capital markets consists of getting excess capital and connecting it with opportunities that essentially fit the risk return profile of that capital. So, in the past, we've seen things like, stock market issuances and IPOs. This is a very, notable and I guess, clear example of that. But I think one of the issues with capital markets, at least historically, is that a lot of the best companies are staying private. And this is why the venture and growth equity sectors and the entire alternative asset sort of investment and alternative asset management sector has ballooned, is because a lot of the returns, a lot of the alpha is getting essentially harvested and captured in private markets before public market outcomes or liquidity happens, like an IPO. And the most clear example of this is something like SpaceX. For example, like SpaceX valuation, I think is well into the hundreds of billions. And by the time this thing goes public, if it does go public, you're basically buying, Elon's 100,000x. So in the olden days, I've tweeted about this as well. Companies used to go public at a very reasonable valuation. For example, Amazon went public, I believe, in May of 1997 for around 400 million market cap. So you could buy Amazon the day it came out, 400 mil, and obviously it's done really well since then. So I think it's sort of a realization. Internet capital markets is born from the realization that the traditional capital markets game is, really favoring private market investors right now and less so public market outcomes like IPOs. And IPO season has been pretty dry historically, at least for the past 10 years. And it's a realization that there's now crypto rails and new financial rails that enable you to accelerate the time to liquidity for these companies. So in the traditional venture model, you have 5-year investment period, 5-year harvest, and you can really only get a return of capital from an IPO an acquisition if your company's acquired, or some sort of cash flow distribution, which is rare.
Yeah.
That's more like typical in the PE model. So basically, now with crypto, time to liquidity is getting expedited from that 5+5 model to maybe 3+3 or 2+2. It's getting a lot faster with token issuances and the sort of the fact that TGs are effectively like on-chain IPOs.
Do you have any examples of who you think has done this on-chain IPO best, or do you have an idea of what that would look like in its optimal state? Maybe you could say who did it best, and then what are they still doing wrong?
Yeah, I think the most unbridled and savage example of this is probably ICOs, in the sense that a company like Binance would do an initial offering of BNB tokens at an extremely low price and cents, and then use the capital to build a market-leading exchange, and then essentially drive value to the BNB token afterwards. I think where it gets a little bit tricky is people don't know what they're buying sometimes. They're all tokens, of course, but there's a lot of governance and rights in TradFi that are very clearly defined. When you're buying equity, you know you're buying a residual claim on the assets, and your losses are limited to the amount that you invest, and you have a possibility for dividend income as well as capital appreciation, which is like capital gains. So it's like very clear what you're buying in TradFi. You've got like Class A, Common, or Class B, or maybe has different voting rights, but you know what you're getting. Same thing with like preferred equity, or if you're lending, right, you're buying public debt like bonds, or maybe it's private bank debt, or maybe it's senior unsecured or senior secured. There's all these different tranches and all these different things. From my time as a banker, you learn about all these things. You learn how to model and build out the capital stack, and you know exactly what the rights are and the waterfall and everything, restricted payments. But in crypto, that clear delineation between tranches of capital doesn't exist in the stack. It's like they're all tokens. So basically, you're like, a token is a token, right? I'm like, no, actually, this one is like completely different from that one, because this token has, 5% of the revenue pointed at it. And this one is a governance token, doesn't have any revenue, and that one has 50% of the revenue. But they're all tokens. So it's like, okay, we actually need to start like breaking these out. Okay, what's tokenized equity that has exactly what I said, a residual claim on the assets, and plus the revenue, plus other things, versus what's like kind of a meme coin. I think this is a clear thing that's missing for people to be able to invest with more confidence, and to really like underwrite these investments and know what they're buying.
Yeah, definitely. That's a huge problem. So these coins on Believe, they're kind of like, people are getting excited about them as startup coins, but then they also have to publicly talk about them as meme coins because of regulatory uncertainty, and they don't want to get in trouble with the SEC saying that it's like a stock. That is kind of an interesting dynamic, and I wonder how we get around that. How can we make it so that one of these startup founders can say, I have a cool business idea and I need some capital, but once I get this capital, I can make a 20 million ARR business, and like, I have a great idea. And then how can we bet on those? Like, I want to back that guy, but currently they have to go through a bunch of traditional stuff, and neither I nor the startup founder know how to do that legally. But we can figure it out how to do it like through a token. If we could only do it legally and he could actually point the revenues at the token, then I would feel as an investor like, yeah, when I invest in this guy, I will eventually get some of that revenue through the token somehow. But like, how do we do that in the current landscape?
Yeah, it's a good question. I think there's sort of like two schools of thought on this, and this is shaped by my conversations at Accelerate with a lot of like different players around the ecosystem, some executives at layer ones, also some founders of popular sort of like pre-IPO or pre-TG listing platforms. I think there's a view amongst some people that the Overton window will get shifted, and basically there will be Reg D and Reg S exempted issuances, similar to how you've done traditionally in crypto, you do, or in TradFi, you do private placement with accredited people, and then you have an exemption to the Securities Act called Reg D. So it's not a securities offering because it's only going to folks that essentially have enough money that they're viewed as sophisticated investors and that they invest at their own risk. That's one view for as it relates to U.S. participants. If you're talking overseas, all you need to do is just KYC, AML, make sure that someone's not on an OFAC list. You need to do a statement of beneficial ownership. So like the entity investing is not owned by someone that's a bad guy, basically. And then that there's no like obviously funky stuff around like money laundering or anything like that. But as long as you've shown that you've done that diligence to a high standard and beyond reasonable doubt, then like you can just sell these things to foreign citizens. There's no restrictions. But as it relates to US specifically, it's either Reg D or Reg S. And then that's the view of like Overton window gets shifted. And then the other view, which is a bit more radical, is that Overton window gets smashed. And you just have dark FI issuances, ICOs 2.0. People are just doing unfettered launches, basically in a legal gray area. They're doing it on decentralized infrastructure that with a distributed validator set, with censorship resistance, can't halt the network. People are just doing things, right? So I'm of the opinion that if the market's opportunity is large enough and it starts with something like secondaries of like Anduril or OpenAI, Anthropic, SpaceX, these sort of startups, then yeah, maybe it starts with secondaries and it goes into primaries where people are actually raising for a 20 million ARR business and they're doing ICOs or whatever. I think it all starts with like one big issuance. If people make money and they see that candle, they see that dopamine hit of like, I invested in, at 1 cent or 2 cents and it went to $20. Like that's going to drive an entire new explosion of issuances and sort of capital markets activity. And typically that's how it goes. Even with meme coins, that's what's happened, right? It's like Bonk went 100x and then you had WIF, PopCat, all these other ones. So people see the signal and they see this and they're like, well, okay, this is on the menu. We can do this and we can raise capital. But then the enforceability of how these things actually, like, if you were to raise capital for a business, how does it get enforced and how do you govern essentially the bylaws of the company, right? Which are like written into like a shareholders agreement in TradFi and they're enforced by law. How do you do that on chain? I think that's a more interesting conversation around probably something like token extensions where you make, for example, say the business gets its revenue into a squad's multisig and then use token 22 and you distribute it programmatically from the multisig to the token holders, or if only accredited people can purchase it, then you have a database of KYC'd wallets that are confirmed to be accredited, and then that token can't be purchased or swapped by someone that's not on that list. So it's like the tech is out there to do this. It's not a complete imaginary problem set. It's like somewhat of a solved problem. I think the biggest bottleneck is the quality issuances, like the quality businesses that actually want to do this and that they're not rugging people, and also the liquidity of like market makers have to provide liquidity to these trading pairs as well, right? So there's a whole issue of like, if there's 20,000 companies, are crypto market makers going to be able to all those? Like the answer is no, absolutely not. Maybe the top 10 or 20 or 30, but they're not going to be able to provide liquidity to all of them. So they'll trade on an AMM, and then the whole issue of like, essentially wide spreads and like high slippage happens again. But crypto traders have been proven to be pretty insensitive to those things. If they think they can make 100x, they're okay with paying even like 10 or 20% slippage.
Yeah, I was going to say like the market making would matter, I think, as it gets to a big enough size, but what we're struggling with right now is just having like quality launches on these kind of platforms, because the biggest problem I see is that there's no clear framework for how to do this like effectively. No one knows like what platform to use, and no one knows how to direct revenues to the token, or if that's even allowed. People are afraid to do that because they don't want to be seen as a security. And honestly, I think that makes sense, because as far as I can understand, it would not pass the Howey test if you were like directing revenues here. So you're either banking on like you're not in the US and like no one's going to come get you for it, or you're like just hoping no one cares, and you're maybe small enough so that no one enforces it. And that's not sustainable. That's not going to attract awesome players. Like, we need some entity to have a structure where people can come, like Web2 founders can come and launch and feel confident that they have a good framework to follow, that they don't need to do all this research on their own, that they know how, like, what tools to use and what frameworks to use. Like, that just doesn't exist yet. I feel like it will eventually, though. And the question is, like, who does that, and like, who's available to buy it? Do you think a centralized exchange is a good like platform to kind of tackle this problem, because they have some KYC AML like capabilities? They also have a lot of trading capabilities. Like, would
Yeah,
you say that? Yeah.
I think it's an interesting question. The risk is typically on the issuer for these sort of things. It's not on the people buying. Like, for example, if you bought ICOs back in the day, you wouldn't get into trouble as much as if you were the issuer. The issuer is really the one taking a lot of the risk. So if you're an exchange and you have a really good business with Spot and Perps and Launchpad, do you want to risk a multi-billion a year revenue business over like facilitating primary issuances? Like, most of these guys don't. They want someone else to take the risk, and then maybe they list the assets on secondary. That's way less risky than actually facilitating the launches. But you're right. I mean, they have the infrastructure in place to do like IEOs. They have the KYC database of people, and they've got the liquidity. Most importantly, liquidity is the hardest to get. So it's an interesting question. I'm of the belief it's going to be on chain. It's going to be more of like a DarkFi type platform. Like, I mean, it's the meme of like pump.fun, but for real businesses, right? Who's building this? It's a good question.
The closest person to that right now is Believe, in my opinion, just because of the quality of people they've been able to attract. I've never seen actual businesses be so funneled into one platform. I do believe there are some pump fund tokens who kind of do like buybacks as a way to share revenue, and they kind of fit that same bill of being like an internet capital markets token. But Believe is the only platform that has like exclusively attracted these companies and been known for that as their platform. There's so many problems with Believe as a platform, though. So it's like they're very much in the V1 of this, and they have like a long ways to go before an actual good quality startup would like want to launch on there, and it's like a good idea for them to do so. I think there are some that want to launch on there, but it's maybe not the best idea.
Yeah.
I guess, have you been, yeah, so what's your take on Believe? Like, have you been watching it closely, kind of more from a distance?
Yeah, I have actually. They've had some interesting launches. There's a trading app called Dextoro that launched on there. I think it's cool because it's pure internet capital markets, right? You don't need VC funding, you kind of just send it. The question in my mind is, like, similar to ICOs, a lot of people in ICOs were just flipping. They wanted to get allocation or be early and then flip for like a quick 5x and then do it again. And what happens when the capital base of your holders are traders and flippers? Like, it's not patient capital. These guys don't have a time horizon for an investment on the order of like years or months, let alone like weeks. Some of these guys are holding for days or hours. So it's like, basically your entire community gives you the initial funding, but then flips, and then other people pick up the torch. But their cost basis is higher, and their expectations are high, and everyone wants to make profit, right? No one is buying for fun. So it's like, I think there's a tension between the traditional model, VC capital. If you're trying to build a multi-cycle product, which is, the hardest thing to do, but also the biggest prize, if you're trying to achieve sustained PMF throughout multiple cycles, it's clear you need patient capital that has a lock. Like, VCs have a 3 to 4 year lock. So that's a requirement. If you want to just try some shit out and see how it goes and do some science experiments, and maybe the thing takes off and you've got revenue, and your token holders, the network effect of like people having ownership and the endowment effect allows you to like bootstrap your 0 to 1 because you've got essentially whatever 5,000 ambassadors for the brand who want it to do well because they're holding the token. That effect is very real. Like I'm not going to sit here and pretend like that effect of having token holders is not like your initial like true fans that will help you bootstrap the product, because it is true. But the question is that enough to achieve revenue where you can live within cash flow? Because essentially, like, once a token is out, and a lot of projects are also seeing this, like you see a lot of hackathon submissions, right, in Coliseum and other things that are like, tokens already live. And I'm just like, okay, well, basically you're not able to accept investment anymore unless it's like public market participants, or if you have a treasury, maybe you can do a locked deal or some sort of treasury deal with a fund. But the ship is sort of like launched. I mean, if it goes well, it goes well. You can live within revenue and grow organically. But in terms of like seed, Series A, Series B, like that opportunity is no longer available for them typically. So you're giving up a lot of future fundraising and a lot of patient capital. The question is that like 0 to 1 initial capital plus true fans cohort, is that worth it? For some people it is. I'd argue for a lot of them it isn't.
Yeah, that makes a lot of sense. I mean, I think some people also, I feel like that some of these businesses have such a small TAM that they're only targeting maybe like a 200K ARR,
Right.
for example. Let's say like that's their end goal. Like a venture capitalist probably doesn't even want to like take the time to like look at that. I think understandably so. They're looking at the bigger prizes. They want bigger deals. And I think maybe that's, a place where this fits in well. But I think, like you said, like a lot of places, this doesn't really fit in well because it eliminates your ability to raise future capital efficiently. And especially with Believe, you don't even get some of your own token. When you launch on Believe, I think now you get maybe between 10 and 20% of your own token, just like naturally through fees, from what I've seen. But you can't actually say like, okay, I'm going to launch with like 80% of the token on my wallet and then 20% goes to public, like you could with like pretty much any other launch pad. You can't do that. And that's like a huge problem because, if you had a supply of the majority of the tokens, you could lock them up and sell them at a discount.
Yo.
But you can't right now.
It's basically a fair launch. I mean, if you're talking about 10% or less to the team, it's a true fair launch in the ICO like sense. So not saying that they're doing ICOs. I'm just saying like it's analogous to that like structure. So I think it's good. I mean, on one hand, there's less locked tokens, less supply overhang, less team sell pressure, less of that. But then there's also like, in some cases, a lot less incentive for the team to work really hard, right? Because if their prize is the revenue, but then again, if the team only has 10% of the tokens and the revenue goes to the token, then they're getting 10% of the revenue. Is that enough to like run the business? Maybe. Is it enough to like keep the lights on? Probably, but maybe not enough to grow fast, right? So if they need to hire a whole new engineering team, or they need to grow in a new region, or they need to execute a go-to-market, these things cost money, and you have to hire people. You have to hire talented individuals to help execute that, right? So I think it's a very interesting question. I think generally for builders, like you said, they want to do more of like, kind of this trend with AI. You see this a lot, like folks like Levels IO and others that are building like businesses for like one guy. The meme of like the guy goes to Thailand or Vietnam, gets a $9 a night hotel, builds a 20K MRR business while on the beach, and he's living the life. Like this is the new face of like micro entrepreneurship, and I think it's a very valid one as well. Like with AI and vibe coding and all these things, this is more possible than ever. I'm not discounting that like approach. I'm just saying folks that are trying to do that, it's kind of a lifestyle business. They want to have some nice income for themselves. It's not necessarily the same approach of like, hey, I'm trying to create massive shareholder value over multiple cycles, build a better product that can be used by a billion people, right? It's a very different scale and mission of what they're trying to do. Both are valid. I just think that like I said, if it's a multi-cycle product, you're really going to want that patient capital that can help you de-risk the business and that can help you grow without the fear of like, are my token holders gonna dump next Tuesday because they didn't like what I tweeted.
Yeah, that's a big problem. I mean, eventually the token you think goes to like stronger hands, like as the people sell. But
If the business is performing, the market will value it where it's supposed to be valued. This is the beauty of like markets. Like even if markets are efficient, inefficient, or semi-efficient, which markets are not completely efficient. Like surprise, surprise. If they were, we wouldn't have a job, right? But what I'm saying is like Amazon IPO'd at 400 million market cap and it ended up in the trillions because, you know, that's where it deserved to be based on cash flows, intrinsic value, fundamentals, and like the growth, the stream of cash flows and the implied growth rate and the expectations of growth of the company valued it where it is.
yeah, that's a great point. I feel like also those things provide some kind of floor to the asset. Like Amazon today as a business will not trade below a certain valuation because it's just worth more than that, like you said, based on a ton of different fundamentals. I think that also would apply to these tiny tokens. Like, there's tokens, if the business creates a good amount of cash flow and it directs that towards the token, there is hypothetically like a floor ratio where you'd be stupid not to own it at, if it was 20K market cap, but it was making millions of dollars of revenue and pointing half of that towards the token every year, you'd be dumb not to buy it at 20K market cap, so then there's eventually a place where it meets there in the middle. And I think that's also a really exciting version of this. It's an exciting aspect of these tokens because for the first time in a while, I feel like there's real alpha in public markets that you can actually create, that if you do your research and do your due diligence, you can find the gems before other people do. With meme coins, for example, it was really boring to trade them personally because you're just looking at like, okay, what KOLs has them and who's kind of funny. And that's about the level of your due diligence. But here you can say like, okay, what's the TAM of this business? What's the prior founder experience? How are they backed by venture capital? Like, what's their revenues like? Like all these different questions that you can actually answer. And it makes it way more exciting to trade. And I think it also makes it that you could safely like ape into a token at 50K market cap because the revenues are more than that. I guess I'd just be curious to get your take on like any thoughts you have on that aspect of this.
Yeah, I think it's sort of like the meme of like the F word, like fundamentals. And now crypto is discovering revenue and they're discovering EBITDA and margins and all these things, right? It's like these concepts have been commonplace in TradFi forever, and then in traditional tech investing, Web2, it's been like a very much an ARR game. And what's your cost to acquire users? What's the marginal value per user? All TAM, like all these discussions have been around forever. But in crypto, this is a relatively new concept because people are playing like a merry-go-round of token issuances, and like this is the whole concept of like thus far in crypto, it's been a token generation machine, like the industry. But how many of these tokens have lasting like staying power? And it goes back to like which projects from 2018 that have a token are making new highs right now. You could probably count them on one hand, right? Very few of them. Because I think there's a blessing and a curse to the early liquidity. The blessing is that it is a refreshing new era of the venture model, and it accelerates time to liquidity, and you can actually get the return on capital, you can distribute it to your investors, and it results in great DPI, great IRRs because it's a big outcome and it happens early in the life, so those cash flows are not discounted as much, so IRR is huge. Great for investors, but is it good for the company to launch a token before they have product market fit? Like the answer is like absolutely not, typically, right? Because it's a huge distraction. Now the founder is tasked with building a company that has an edge in the market, that's delivering a superior product that people will pay for. they have to do that, and they have to also make sure the token price is up, because now they have two problems, and a lot of people are unable to negotiate that, and it creates some perverse incentives as well of like, why is there an absence of Series B and market in crypto? I'd argue mainly because there's not a lot of revenue. If there was a lot of revenue, there would be a lot of investors, but also because TG happens typically before the Series B. It's like typically it's been like pre-seed, seed A, TG, or even pre-seed, seed, TG now, or now just TG directly. So it's like, what's left for a Series B investor if the token's already live? The answer is like probably not a lot, right? So it's all a question of revenues. I fundamentally believe that if revenues were stronger in the industry, people underwrite revenues. They can discount them, they can do their fundamental analysis, they can slice them and dice them, and they can value these businesses intrinsically on fundamentals of like a discounted cash flow. So if this is sort of the meme of like, people aren't buying stocks or tokens, they're buying reasonably priced streams of cash flow, right? So I think that's where right now there are some cash flows, don't get me wrong. There's a lot of app revenue on Solana. 80% of the industry's app revenue is on Solana. Is it reasonably priced? That's a whole different conversation. I don't believe it is. But fundamentals are sort of in the background right now. They're not completely in the forefront, but they're getting more prominent over time.
If a startup founder came to you and he wanted to launch on Believe, and he said, how do I point my revenues toward the token, what would you tell him?
I mean, I think it's against Believe's terms of service, first of all, because they don't want that to happen. But if they wanted to do it, I mean, they could just, mechanically, it's quite simple. Like, you just do a cash sweep and programmatically like distribute it, or make it a click to claim or whatever. Now, there's like obviously legal discussions around that. I'm not a lawyer. I'm not advocating for anyone to do this. I'm just not giving financial advice. I'm just saying, like, it's clear how you would do it. The question is, like, are they willing to take the risk, and how will the market value this, and will they be receptive to it? I think generally people also have the issue of like, there's nothing worse than low revenues, because then you're fairly priced and your valuation is low. So pre-product and pre-revenue typically is what makes the most money. And founders know this too, right? Founders would rather TG before the product is live, and then, you know the game. Pump the token with market makers, hedge, and then, it's good night. So that happens a lot, but without commenting too much on that side of the industry, I think, you have to have a real business. It has to have a defensible business that has some sort of long-term competitive advantage that's defensible. And those revenues have to be not only intermittent, they have to be like protected with some sort of edge around distribution, licensing. A product by itself is not typically like a complete moat, at least not in the long term. You have to have something that you're doing that other people cannot do.
Do you think Hyperliquid does a good job of distributing revenues through token buybacks?
I think they do. I think people are really excited about Hyperliquid because it's a superior trading experience to what's existed in the decentralized space. Like, if you compare this to GMX or DYDX, a Hyperliquid is just like a dramatically better product. They have a ton of liquidity. They have almost as much open interest as OKX. I think they flipped them briefly, which is pretty crazy. Like, OI is such an important metric for a perps exchange, and Hyperliquid has been killing it. Like, they have undeniable product market fit. I think the reason why people like Hype, there's a couple reasons, but they like the fact that they have a lot of revenues and that it's a good product. And crypto has gone sort of like through these waves of like decentralization, where decentralization was the product, and then that was the first thing. The second phase was like, we've got products, but it's decentralization first. And now we're in the third phase, and we're like, okay, just give me a better product. I don't care that much about decentralization, which TBD if like people value decentralization again. I know when like stuff like FTX happened, people definitely got like a lot more, sort of like cognizant of the importance of decentralization and like the ability to hold your own private keys, or sort of like not have a run on the bank and not lose your money. But at the same time, people's memory is short. And I think, I'm not saying that's going to happen to Hyperliquid. I'm just saying these sort of events cause people to like revalue decentralization. But right now, it seems like the market's willingness to pay for decentralization is like pretty much at an all-time low. You had essentially a rollback on SWI with Cetus. Community applauded it because they got their money back. And Hyperliquid is centralized, runs on a multi-sig. People don't care. They just want better products.
Yes, that's very true. I saw one guy say, it was Jonah from Empire, the Empire podcast. He said that Hyperliquid was the closest thing he's seen to a tokenized equity, and he can't think of why it's not, because of the way that they do buybacks, and that's like a stock doing buybacks.
Yeah.
I think there's like a very big sentiment in the market for liking Hyperliquid that way, and I think people want these other ICM tokens to be like that, to where they make good money and then they use it to buy back and distribute it, because I think that's seen as like a legal loophole around being seen as a security, that like you can do buybacks instead of just distributing revenue, because if you distribute revenue as a dividend, that's like more obvious and overt, I guess. But if you do buybacks and you don't market it as a token, that or as like a cash flow, that's the biggest difference. And I think that's also one of the differences with Believe's TOS. Like I think you can market it as like a flywheel with buybacks, and you can say like, yeah, we're buying the token back, and then traders can infer what that means. But you're not saying I'm going to give you cash back in the form of buybacks. You're just saying I'm buying back the token for business purposes or whatever. And I think that's kind of the legal gray area that we find ourselves in. I'm really excited to get on. I have this ex-SEC lawyer coming on the show in a couple days, and I'm really excited to get her take on this, because the legal gray area seems like that's where all the alpha is.
But then you've seen like Atkins, the SEC chair or SEC head, come out and say that decentralized finance is basically on the menu, right? And he said that if it's just software and it's immutable, and things like, for example, like if the upgrade authority is burned and like the program is immutable, then it's just decentralized program. Like, it's just open. If people want to misuse it, it's on them. It's not on the developer. So I think like this is now a new frontier in finance, where if it's truly decentralized finance, then it's okay. But if it's fake decentralized and it's running on a multi-sig, and the developer can issue tokens and increase the supply and mint and upgrade and change the smart contract, then like obviously it's not decentralized, right? So I think what they outlined in that thread, which was really incredible to see the SEC tweet this, is like basically they're in favor, or they're pro like true decentralized finance. What they have an issue with is like companies that are masquerading as decentralized when they're not, right? And so like, for example, running on a multi-sig is the most like quintessential example of that. But most of crypto runs on multi-sigs. So it's like, that's a whole different conversation. But I think now the lines are a lot less blurred now. Now it's like, it's white or black. Like you're either decentralized or you're not. Actually, Armani had a good tweet about this, of like, he proposed splitting out decentralization into like verifiable finance versus autonomous finance. So verifiability being like, for example, I can verify with a ZK proof or some sort of like daily attestation or weekly attestation that my funds are on the exchange, and then that money is in fact there, right? Versus some of these other exchanges are like just a black box. They say the numbers are on the screen, but like, is your money actually there? Like no one knows. There's no audit. Maybe one audit a quarter, one audit a year, and the auditor signs off and says it's all fine. It's like, okay, it's a lemons problem, right? You have to assume that like maybe it's not there. But my point is like, that's verifiability. And now autonomous finance is like an like immutable smart contract, like no upgrade authority, like the program just exists. It's a tool, public financial infrastructure, interact with it if you want, and it's autonomous. Like the developer can't rug you even if you wanted to.
Yeah, that's really exciting. I wonder if there's going to be some SaaS like company out there who the payments happen in USDC, and like I don't know, the product runs on a server somewhere, but like the payment is all through like a smart contract, and then that gets automatically distributed through through token holders basically. I feel like that's a way you could say like, hey, I can't even stop the dividends if I wanted to. Like it's not even me doing the dividends. So like, why are you going to come after me? I just made the product, you know? Like there's all these legal loopholes that I love about crypto. I'm so happy that I'm in this industry because that's exciting to me. I think like we're seeing it now that crypto moves faster than the regulations do. And if we can just like skirt around the current regulations, that's where all the fun happens, I think.
Yeah, and honestly, this is just like a recreation of what exists in TradFi. So in TradFi, you have a business, revenue comes in through the door, you've got your operating expenses, and then, operating cash flow, you have a cash sweep, and like the money goes like in accordance to like the waterfall of like the liquidation preferences, and it will go to like debt first, right? And it will go, to pay interest and to make principal payments as well as interest payments, and then it will go to preferred equity, then like maybe perhaps like I don't know, like mezzanine debt, then preferred equity, and then like common equity would be last. But like my point is that entire like structure and waterfall of how like revenue and cash flow flows through like the pecking order, this can all be like programmed. It can be like captured in an on-chain program that does the cash sweep and it just redistributes it out. It's just like the same process running on like crypto rails instead of traditional rails. So it can happen to Armani's point with a higher degree of verifiability. You can see these things happening real time. You can see, hey, revenue coming in through the door and here's how it flows. And then it also happens in a more autonomous way of like, to your point, it's happening automatically and there's no possibility for those funds to be embezzled or for them to be allocated in any way other than the way it's coded. Like code is law.
Yeah. Yeah, that's exciting. What excites you in crypto these days?
Honestly, I think there was this whole discussion in 2021 of like what blockchains are going to be used for, and there's these very grandiose visions of like gaming and metaverse and creator economy and like everything. I think in many ways crypto didn't have the infrastructure to back it up, and a lot of those dreams were like pipe dreams, and it was a beautiful time just because people were dreaming big. But I think they're a lot more pragmatic now, and they're actually like narrowing in on a few killer use cases for crypto, which are like trading, payments, and like coordination. And I'd refer to coordination more broadly as like it can be accomplished like via DePIN, for example, where you coordinate digital commodities like bandwidth or compute resources, or you can coordinate capital or users or devices or even like agents to do things. And you do that with tokens, right? So I'd say broadly speaking, it's really like trading, payments, and coordination. Those are like the three killer areas. And then there's like different offshoots and branches of the tree and little like branches and sub branches and leaves amongst those areas. But I think generally what's exciting is the ability to spin up new markets, issue assets natively on chain, have them trade permissionlessly with 24/7 liquidity on an AMM, then they migrate to perhaps a central limit order book. And to be able to spin up a market really quickly and just enable the trading of the long tail of everything, that's exciting to us, obviously. And then what does the market structure look like? Does it start to look like payment for order flow? Does it trend towards TradFi? Is there a new market structure that's emerging? We're spending a lot of time researching that right now. But I think more broadly, we've been pretty excited about some of the infrastructure and the backend services stuff. So we recently made an investment in Pipe Network, which is building, we like to call it like essentially almost like decentralized AWS, where historically applications have run on centralized like hardware and services, right? So it's like you have your like order book or DApp or whatever, but it's running on AWS East, which is like problematic for a couple of reasons. First of all, like it's a centralized entity and there's a single point of failure and you can get censored or whatever. But more importantly, I think historically, like these data centers have been pretty far from the end user. So your average, like, for example, content delivery network, that CDN is happening, like that data center is 200 to 300 miles away from your house, which introduces a lot of latency. But if you can cut that down by 90% and make it 10 miles away, like Pipe has, then you collapse the latency and the UX is way better. So what's interesting is like these pieces that Pipe is building, starting with storage and content delivery, they're interesting in and of their own right. Like Pipe is a 10x better storage solution. They're a 10x better content delivery. Like, those businesses stand on their own two legs by themselves. But when you bundle them together and they're integrated, like AWS, that's where it gets a lot more interesting because you add access controls, you add video transcoding, video streaming, then you can build decentralized YouTube, right? You've got the storage, you've got the cache layer, you've got the content delivery. So you're describing like the backbone of YouTube. So it's like, I think the scope and possibility of what you can build when something like Pipe exists is just expanded dramatically. Now it's like, hey, to throw up a front end, work with Pipe, and you've got decentralized YouTube, So it's like these things that were really a pipe dream last cycle, I think sometimes they're being now like enabled real time. It's just people they're not clued in until they see it in the pudding. They need to see they need to go to www.youtube.com, decentralizedyoutube.com, and then they open it up and watch a video and they're like, oh my God, this is amazing. It's possible. It has to be like so obvious it's hitting them in the face. But in our mind, David and the work that him and his team are doing is incredible because so many markets are now enabled. Like they can build oracles, they can build decentralized VPNs, they can do application hosting, elastic storage. Like it's really the entire Amazon Web Services like offering, but it's hyper localized because these nodes POP nodes are 10 miles or less from your house instead of being like 200-300 miles away.
That's sick.
So it's pretty amazing. Yeah, like pretty amazing business, and I think they should get a lot more credit for what they're doing because it's a sleeper. It's a sleeping giant, and it's incredible the like applications that it enables. I think that's the most exciting thing is like in the same way that AWS powers just trillions of dollars of value, and then it has a small take rate, and all these applications run on AWS. It's like very similar. Like it enables the entire decentralized internet to flourish, and it really just allows a lot of these businesses to go 0 to 1 because infrastructure is still like not there. Anyone that says the infrastructure is there is lying. Like we've got a long ways to go, so I think there's a lot of opportunity still.
Mm-hmm. Yeah, I saw David. I believe his name was David Rhodes, right? He's the founder of Pipe Network. He gave a talk on it at one of the breakpoints that I watched. I thought it was really interesting. Remind me, is it a DPIN model? Like, can I set up like
Correct.
a Pipe Network node?
Correct. Yeah. You can set up a POP node. You can provide bandwidth, and you can join today. Like it's already live. They've got over 200,000 nodes in the United States and globally. So it's like already scaling at a very accelerated rate.
That's awesome. Another frictionless capital company I really love is Andrina. I got to see Neil again at last Solana Accelerate. You should, if anyone doesn't know what they are, you should check them out. Super cool. I love DPIN, and it seems like that's a good focus of your fund as well. That you guys are focused on that as a vertical because you guys aren't really focused on DPIN. You guys are focused on better products, and DPIN just happens to be
Exactly.
a way to get there.
Yeah, exactly. We actually just like this is a hard line for us internally. Like if it's not a better product, like a 5-10x better product, it's just a no. Like it can't be a robotic horse when cars exist. We're not recreating problems here to solve them, right? We're saying, okay, how can you use crypto as an implementation detail to enable a strictly better product with like emergent UX? Like how can you do things that have never been done before using crypto rails and tokenization and shared ownership and incentivization and all these things. And I think that's the wonder and the promise of crypto, is that really talented founders like David, who used to work at Amazon, like they can actually look at the space and say, hey, using, taking these valuable pieces of crypto, I can actually build a business that is 10x better than, a traditional CDN or traditional like backend services company. And it's scalable with web scale. It enables 90% lower latency and 75% lower cost. Like that's where I think the real promise of crypto is. And that's where it goes from being like crypto being this weird like Wild West of like experimentation and speculation into like, okay, this is actually just tech. It's fintech. It's just strictly better technology, and of course strictly better products. That's the best thing is when you can enable something that's never been done before.
Exactly. Do you guys do liquid investments at Frictionless, or are you mostly focused on venture?
We do liquid, but we take a sort of liquid venture approach where we are not traders. We don't think of ourselves as traders. We're not like buying and selling. We're not shorting. We're not using leverage or any stuff like that. We're doing deep fundamentals based, like thesis driven investing, where we do a bunch of work on something, we look at it and we think it's mispriced and we think the market is not valuing the market correctly, and that good or service or product is just really oversold and the market's getting it wrong. We're not opposed to accumulating it. For example, Solana is one of such examples, right? We were accumulating Solana in the bear market when it was non-consensus, and we published our thesis on our website at, I think it was like $12 or $13 a coin, and we were just like, basically the market's getting it wrong. This thing's way oversold. It's got this overhang from FTX. Everyone's shorting it. It's got some very unique properties and optimizations that no other blockchain in the industry at the time was optimizing for. And we think it's a huge asymmetric opportunity for the upside, right? And as it turns out, it was. So we'll not do this like constantly all the time, but it's part of the fundamental analysis that we do, right? If we do deep technical research on a stack or market structure, order flow, like MEV, all these different things, like that informs the venture side of the house, but it also informs the liquid side. Like if we can buy a token without a lock and achieve venture scale returns on it by holding it for a year, 2 years or 3 years, like of course that's great. Like why wouldn't we want to do that for our investors?
Yeah, I love that you were pretty loud about supporting Solana still during the bear market, because you were someone I followed during the NFT craze, and then still seeing you bullish on Solana and you explaining like why really helped me also like believe in Solana at the lows, and I loaded up a lot in the bear market, and that let me focus on this podcast and to focus on crypto more full time. So you and Logan's podcast too. Logan's podcast was a big inspiration for me. Are you going to be at Permissionless?
I won't actually. I'm going to be traveling, but I think honestly the biggest takeaway from our side is that a lot of these assumptions about crypto and blockchain that are so deeply and like fervently held, and in 2020 and 2020, or actually 2021 and 22, it was like Ethereum had won, layer 2s were going to scale the industry, and the monolithic thesis was dead, and Solana was an FTX chain. Like all these things actually proved to just be false. So, it's sort of like the matrix and the quadrants of like how to outperform, and you have to be contrarian and right. And people have to be wrong. The consensus view has to be against what you're buying, because if what you're buying is consensus, like if you're buying hype right now, or you're buying a lot of these other coins that people are talking about constantly, even Bitcoin. Bitcoin is different because they have a secular like trend now, and there's sort of institutions accumulating. But my point is, if it's consensus, then by definition it's going to give you average returns, right? Because everyone else is buying, so it's fairly priced. So I think the biggest opportunity in markets, especially liquid markets, is when you have a dislocation between price and fundamentals, where the market is not understanding something correctly, you can buy it at essentially way discounted of relative to where it should be. You take a big position, and then the market then realizes, okay, this was actually good tech, and it's actually got huge growth possibilities, and then it gets regraded upwards. And I think that's the essence of like asset selection. This is what a lot of hedge funds don't do in the industry. A lot of hedge funds play the narrative game. It's a game of musical chairs. They rotated from Tau to Sol to agents to hyperliquid. They're just playing a game of like dumping on each other. Like if you start the meta and you're like, hey, I'm bullish on robotics, you buy a robotics coin, tell all your friends to buy it, then you sell on them. That's not really like deep alpha and asset selection. That's just like playing the rotation game. And I just don't think that's fundamentally as interesting as a job as being like, okay, where's the deep value? Where's the deep alpha in the market? And yeah, like people are going to clown you. They're going to say you're dumb for buying that asset. But at the end of the day, the market decides who's right and wrong. So, you have to be buying things that are unpopular. You can't be just like buying the most popular things always and expect to outperform consistently.
Yeah, well said. Well, Diego, it's about an hour. I think it's probably a good time to wrap up. I know you're a busy guy. You got a lot of stuff to do. Is there anything else that you'd like to touch on before we wrap up?
Honestly, I think people ambulate between the like, we're so back and it's so over. But it feels like the industry is really expanding. Like, if you look at the regulatory side, we had a SEC that's gone from like regulating via enforcement, chasing founders out of the country, serving people and subpoenaing people with no notice, to basically tweeting about DeFi and how bullish it is and how transformative it can be. So it's like, that's a complete 180. You've got the two best IPOs of the year, CoreWeave and Circle. CoreWeave started out as a crypto company, then pivoted. Circle is just a crypto company. TGEs are, I guess, slow, but we've got IPOs, which are like TradFi TGEs, like call them like boomer tokens or whatever you want. Stocks are ripping, right? Crypto, there's a huge appetite for crypto amongst institutions, and TradFi are seeing, BlackRock ETF, fastest ever ETF to 70 billion or 90 billion or whatever it is now. One of like BlackRock's best ETFs ever across all product categories. So it's like, I think it's a tale of two cities. Like, you've got the on-chain economy and people are down bad. No crying at the casino. They lost their chips. They're crying at the table. They're waiting for Bitcoin to pump to kind of bring some oxygen back onto the flame of the market. But like, and you've got TradFi, it just doesn't care, shows up every day and buys. So it's like, I think you have to be able to play both sides. You can't operate in a vacuum. You can't only look at TradFi because that's a super lagging indicator of what's actually going on. But then you can't only be on chain, because then you're just like a trench warrior, and you're losing the forest from the trees. You're too in the day to day, and you're not realizing, hey, you got to take a step back and actually look. There's a secular trend that's transformative, that the industry is accelerating, in our opinion, from like $3 to $4 trillion market cap to like 10 to 20 or 30. So our bet is not so much on like, okay, hey, is this coin going to do a 5x? Like, we're thinking more, hey, industry is expanding. This is a secular tech trend. It's not slowing down. If anything, it's accelerating. There's institutional buy-in. Regulatory environment is getting completely ironed out. Genius Act just passed. And crypto finance is going to become just finance, in the same way that like web or .com companies became just tech. So it's like, you can't fade the trend, and you also can't lose sight of like what a big opportunity this is, right? If you have a long-term view, which we do. A lot of people don't have a long-term view, and we find many of our disagreements are just a question of like differing time horizon. People are thinking in terms of like days and weeks, or weeks and months. We're thinking in terms of like years and decades. So it's a different approach, but my message to the audience is just like, don't lose sight of the trend. And like, the movements about the trend can be random, they can be volatile, but the trend is up.
I love that. Really well said, Diego. Before we end, I gotta ask you, how do you express that view? You have a unique perspective and a unique opportunity being a venture capitalist. You can get in, really early at seed stages with these really cool companies like Andrina and Pipe and all these different ones. But if you were a liquid investor, purely just a random guy on the street, how would you express your view? Because I think your view is one that I share, and I would love to hear, how you would express your view if you weren't in the venture side.
Yeah, I think you have to take some of these unloved categories that have huge potential and have been oversold. Like you have to look at something like Deepin and maybe not the legacy projects as much, like the ones from 2019, 2020, but some of the new sort of like new wave Deepin projects that are coming out are very serious contenders. Like things like Pipe Network are scaling at a rate that we haven't seen before. And the scope and the scale of what they're delivering is also unprecedented. So a lot of people tend to like invest on categories, and they just like lump them together, and they're like, okay, Deepin as a whole is not performing, so let's just throw the baby out with the bathwater. But you have to actually parse apart these different opportunities, and you have to say, okay, this is actually working, this is not working, and let me lean in harder here and actually be concentrated on a couple opportunities. Because the more work you do, the less you want to diversify, because you realize, okay, this company is actually just strictly better than these other 20 companies. So I don't want to misallocate. I don't want to dilute my returns holding these dogs when there's a star here. I want to actually just put like a big portion of my book into this, because like there's not that many like incredible companies. There's a lot of like pretty good companies, but in terms of those like secular outperformers, like top decile or top 1%, top 0.1%, there's really not that many. So when you find them, you need to just load up. Like you need to be opinionated and concentrated enough to build the thesis to buy, but then you need to have the thesis to hold, and you need to update it with new information constantly. You can't just like convince yourself at a point in time that it's going to win forever, because things change, right? And as the saying goes, like when the information changes, the thesis changes. And you have to constantly revisit it, and you have to FUD your own bags. And we joke about this, like no one's better at FUDding our bags than ourselves. Because if we don't FUD our bags, then the market FUDs our bags. And if the market FUDs your bags, you're already down bad.
Well said. The problem I have with some of these Deepin ones, just real quick, is like the liquid token doesn't become purchasable for me until it's already at a very high valuation. And I guess that's one of the things that I struggle to, I guess justify buying something that I believe in. Like, and also the token doesn't necessarily like benefit a lot. Like Hivemapper is one that comes to mind. I love the Hivemapper company. I wouldn't buy the token myself just because I don't feel like the risk reward is there. I guess that's what I struggle with. Like I have so many cool, like Deepin projects that I love, but they're like uninvestable to me, either because the valuation is off or because there's simply not even a liquid token out for them yet.
It makes sense. I mean, I think also one aspect of these Deepin networks that needs to be highlighted is the ability to earn in by being a contributor. That's underrated. Like in the case of Pith and other projects, like the vast majority of the tokens actually in a lot of these projects goes towards contributors. And even the early investors end up with less tokens than some of these guys who really like leaned in and did an SPV and brought a bunch of like value to the network. And ended up getting paid in spades just from the tokens that they were getting, right? So I think there's a certain amount of this that's like everyone wants to be early, everyone wants to snipe the earliest round, fine, but you can actually earn in a very meaningful way here, and it's a lot of times just putting the pieces together. Like, hey, a guy on the West Coast that has a ton of data centers or fiber or whatever, or you're connected to someone who's connected to him, okay, or her. Go talk to him and be like, hey, have you thought about providing bandwidth? Have you thought about pointing your, fiber footprint at this thing? And a lot of times it's just an open conversation. Like you lose nothing, and then potentially there's a high IRR for him, and plus some sort of crazy earn in just by putting together a deal. So you have to be like kind of an operator. You can't just be like purely a financial and just be like, all right, let me sit back and just like do the shopping list and just pick everything. You have to actually roll up your sleeves and be like, okay, am I better off buying the token? Am I better off, bringing these guys a bunch of supply? Like, just look at it from a total return standpoint. Maybe a combination of the both. Maybe if I do, bring a lot of supply, they'll let me invest at a better valuation. Like, it's all open.
That's a really great point. I love that. Diego, thank you so much for coming on. I really appreciate your time. If people want to go find you, check out your Twitter. It'll be in the link. This will also be posted on Twitter, so you'll definitely be tagged. And yeah, thank you so much for coming on, Diego. It was a pleasure.
Yeah, thanks for having me, Nicholas. A lot of fun as always.
Until next time.